Suppose you have 100,000 and you are undecided whether to put it in a SACCO or a Treasury bond. So today we will compare the benefits of putting it in either a SACCO or a Treasury bond. And you're going to look at returns, liquidity, loans, and interest rates. Now for SACCOs, there are two ways of earning money in a SACCO. That is through dividends, which is paid on the share capital, and rebates, which is interest earned on your monthly contributions. Now for this case, we will use an example of one of the regulated SACCOs that I consider stable, that pay dividends at a rate of 14% and rebates of 9%. Now, taking 14% on 100,000, you will earn 14,000. The beauty about SACCOs is that it inculcates a savings culture. For this particular SACCO, the minimum monthly contribution is 3,000 bob. And for the monthly contributions, the SACCO also paid interest of 9%. So you will earn around 1,485 shillings. Now, I'll make a video on how I arrived at this, so follow and stay tuned. So that's a total of 15,485. Now, this also, the interest also attracts a withholding tax of 5%, so that comes to around 774. So that's a total of 14,710. Now for Treasury bonds, we will use an infrastructure bond which has an interest rate of 15.837%. So the coupon there will be 15,837. The withholding tax is 0. So the total is 15,837. Now remember, for SACCOs, there are SACCOs that pay as much as 21% and others that even pay lower than this. So this is really relative across SACCOs. Now let's look at the liquidity. SACCOs share capital is non-refundable. Now in case you need your money back, you will have to transfer to an existing member. For Treasury bonds, you can sell it in the secondary market and you can either gain or lose part of your capital depending on where the yield is. Now let's look at loans. For SACCOs, you can borrow 3 times your savings, meaning in this case you can borrow up to 300,000. That is 100 times 3, that is 300,000. But remember, since your share capital is only 100,000, you will need to get guarantors for the 200,000 to guarantee that loan. Now for Treasury bonds, you can get up to 50% to 70% of the value of that Treasury bond. Now the lower side, which is around 50,000 to 70,000, the lower side is for older bonds. This is because they have considerably lost value as a result of the increase in the interest rates. Now, as for the interest rates, SACCOs charge an interest rate of 12% on loans, while if you are to get a loan from a bank using Treasury bonds as collateral, the bank will charge you an interest rate of 15% plus risk margin depending on your risk profile. Now you're in the know. Follow and stay tuned for more.